Disruption is a phenomenon that creates tremendous investment opportunities. We're going to tell you about one ETF focused on the disruptors. Plus, we're going to tell you about an area of the high income market that investors have been flocking to and an ETF that tracks it. Lance McGray at Advisors Asset Management joins us right after this. Welcome to the program. I'm Ron DeLegge with ETF Guide. Thank you for joining us. If you're new to our channel, be sure to hit the subscribe button and the like button if you've been enjoying our content. This will ensure that you never miss any of our original episodes. Investors face a lot of challenges, from stubborn inflation to high interest rates. And on today's program, we're going to focus on ETF solutions to address some of these obstacles. Joining us is Lance McGray, head of ETF product at Advisors Asset Management. Lance, welcome to the show.
It's great to see you, Ron. Thanks for having me.
So let's start with the recent trend in Consumer Price Index and the PPI, also known as the Producer Price Index. These figures and the recent trends, it appears that your view of higher interest rates for longer is indeed playing out pretty accurately. With that said, investors are facing many challenges, including how to source meaningful income while navigating the impacts of sticky inflation and higher rates. So is there an area of the investable market that you feel that investors should be paying more attention to?
Hey, Ron. Yeah, absolutely. We are in some very difficult times. Investors are facing very, very difficult questions, specifically those that are focused on income solutions. Yes, obviously interest rates are high, income levels are high, but at the same time, most investors need more than 4.5% income to live on if they're on a fixed income budget. So yes, there are a number of areas that we really prefer in this type of market, and we have been sort of touting that for the last 6 to 12 months. One area that we are really interested in right now, specifically for those income-seeking investors, is preferred stocks. And we think it's a sort of underutilized asset class for these investors for a number of reasons, but the timing right now is really, really important for these investors. Few of the reasons why we like this asset class: first and foremost, there are 10 to 15% discounts with retail preferred stocks right now. Yes, we've been coming out of the regional banking crisis. We've emerged out of there rather unscathed. We think the risks associated with that are quite idiosyncratic in nature, and that we've moved beyond that. But still, we have this asset class that is, really out there because banks issue these preferred stocks, and because of that, they're still trading at 10 to 15% discount, which creates a fantastic opportunity for investors, not only looking for income, but also could reap capital appreciation rewards as well. So that's one of the major reasons why we like preferred stock. The other one is, as you know, preferred stocks offer attractive income levels. So if investors are looking for elevated levels of tax-efficient income, quite honestly, in the fixed income arena, there's no better place right now than looking at preferred stocks, 6 to 8%, investment-grade securities with very low default rates, very, very attractive. And then finally, when we really get into the nitty-gritty of the market, if investors are in the same sort of attitude and outlook as us here at AAM, we're coming up upon the end of a rate hiking cycle. Historically, preferred stocks have performed exceptionally well. In fact, if you go back to 1990, preferred stocks have returned on average over 14% over the next 12 months following the end of a rate hiking cycle. So if you think about preferreds in terms of investment grade securities or high grade junk securities or high yield bonds, preferred stocks are looking very attractive right now, and we think it's an area that investors should look at.
Makes sense. Now, AAM offers a unique lineup of income solutions, and investors have been responding favorably. We see that with trading volume increasing along with asset growth. So can you please provide us with a quick update specifically on PFLD and why investors have flocked to it?
Sure. So PFLD is a really interesting, unique product that we have here at Advisors Asset Management. To be honest with you, it's the first and only low duration preferred ETF. As we were discussing earlier, The relative outperformance when interest rates were rising was quite startling. It did exactly what it was supposed to do. But again, this is the first and only low duration preferred product. It's a rules-based solution that's benchmarked to the ICE 0 to 5 year exchange listed preferred and hybrid securities index. But I tend to think of PFLD as, yes, it's a rules-based index, but it really has the feeling of an actively managed product. And what we've tried to do with PFLD and the underlying index is really to sort of put guardrails on, what I would consider a rather risky asset class, right? When we think of preferreds, we think of credit risk, we think of call risk, we think of duration risk. And within this portfolio and within this strategy, we try to minimize two of those three risks, that being duration risk and call risk. And quite honestly, that's exactly what this portfolio has done. So we're looking at a product that provides the similar benefits of, the traditional preferred stock asset class, high tax efficient income, diversification, capital appreciation, but we're doing it in a nature that's, the product right now has a effective duration of 1.65 years. The broad-based index, preferred stock index, is 5.9 years. So again, substantial reduction in duration risk, but we're also minimizing call risk as well. So again, the way that I think about PFLD, which is gathering a tremendous amount of assets, we're approaching $300 million organically, is think about it, training wheels on a bike, right? The training wheels on a bike allow the person on a bike to enjoy biking, enjoy bike riding. They make you not fall over, but it's not a governor, right? It's not restricting your enjoyment or restricting your speed. And that's exactly what we have sort of here with PFLD, in that we're getting the benefits of the preferred stock asset class, but we're minimizing duration risk, we're minimizing call risk, and we're providing a very attractive income level. Right now, the SEC yield on PFLD is 6.6% with a QDI that's over 75%. So on an after-tax basis, PFLD is looking very, very attractive. And then you throw the discounts on top of that, and it's not shocking to see investors finding a real place for this in their portfolio.
Changing gears slightly, despite last month's tech-driven sell-off, we see the S&P 500 is nearly back to all-time highs as many of those high-flying tech names have bounced back. Now, some of these technology companies within the S&P 500 are capitalizing on disruptive technologies like blockchain, as well as artificial intelligence. And at AAM, you have a unique ETF that's geared toward this trend. It's called the AAM Transformers ETF. That's ticker symbol TRFM. Can you tell us a little bit more about what the fund does, how it invests, and some of its holdings?
Yeah, absolutely. And TRFM is another product of ours that's gaining traction. It's really created to embrace the power of disruption, as you mentioned. In this day and age, obviously growth and technology names have had a substantial run over the past decade. But we think that there's embedded risks in investing in these companies, right? Number one, if you think about the S&P 500 or the Qs, there's substantial concentration risks. If you look at the S&P 500, the top 10 holdings of that index account for 33% of the portfolio. If you look at the more tech-focused NASDAQ 100, the top 10 holdings account for nearly 50% of the portfolio. And we think here at AAM that concentration risk isn't necessarily needed when you're investing in these tech-heavy growth-type portfolios. And for that reason, that is one of the areas that when we created TRFM, we tried to minimize. And if you look at TRFM's top holdings, you get the same exposure pretty much to all these growth names, but the top 10 holdings only account for less than 10% of the portfolio. So that's one of the bigger areas that we're focusing on, is sort of broadening out of that tech exposure within the portfolio. And sort of along the lines of that is, we've moved away from focusing on mega cap stocks and market cap weighting securities, right? So again, we're moving away from high concentration and mega cap stocks to a portfolio that's not only looking for the mega cap growth stocks, but we're looking for the next Teslas. We're looking for the next Apples and Microsofts and NVIDIAs. And I think that's a huge talking point in this day and age, and that the growth of this industry doesn't have to be driven by the top 7 or 8 names in the broad-based indices. And quite honestly, Transformers has performed well and shown that there's a lot of growth in other areas outside the 7 or top 10 largest holdings in these broad-based indices.
Yeah, we've seen TRFM outperform the S&P 500 over the past year. So that formula that it's employed for investing certainly has worked.
Absolutely. And the last thing I'll leave you with Transformers, and this is always certainly a major talking point of ours when we're talking to investors that are either looking to redeploy assets in the tech space or the growth space. A major component of TRFM and its underlying index is sales and analyst ratings, but also R&D, right? And when it comes to R&D, most advisors that we speak to, when I ask them a question, when we look at R&D spending as a share of GDP across the entire investable universe, what portion of that R&D comes from U.S. domestic stocks versus that of international stocks? And generally speaking, they'll say, "Oh, wow, the U.S. domestic names must be, a big driver of R&D, total R&D invested." And the fact is, only 30% of global R&D spending comes from domestic companies. Nearly 63% comes from international names. And with TRFM, almost 25% of our portfolio is geared to international names. So again, you get exposure to smaller cap, mid cap tech names. You get additional diversification across geography. And when you're looking for the next big thing, like we are with Transformers, it makes a lot of sense to look outside the U.S. and look for international companies.
Great point. Innovation can happen anywhere, and it is. So one final question before you take off, Lance. How do you see funds like PFLD and TRFM being deployed by advisors and investors?
I would say that these products necessarily aren't the core holdings. They're not the traditional large cap value, large cap growth. There are areas within pretty much within many investment portfolios that these belong. So in terms of PFLD, we've been really looking at a number of buckets for investors. Number one, there's a tremendous amount of cash on the sidelines. Yes, they're getting 3, 4, 5% in money market funds, but sometimes there's reinvestment risk. And we're finding a lot of investors coming off the sidelines, putting in a solution like PFLD where you can get 6.5%, 7% income with minimal duration risk. And it's a way to get back into the market without taking full-blown equity risk or extending your duration too much.
I was going to ask you real quick, just to interject, many investors, even with core bond index ETFs that are broadly diversified, were shocked when they saw some of these bond funds get hit pretty hard during that rate hike cycle. So could you see a fund maybe like PFLD, investors looking to maybe replace some of those core bond holdings or maybe supplement them? Would that be another possible solution?
Absolutely. I would say supplement, right? We're not going to take a low duration preferred product and make it your core fixed income product, right? While I have seen that, I wouldn't recommend that, but definitely along the supplement lines and more about, if we're talking about replacement, right, a better area to replace your existing portfolio is probably on the high yield side, right? When you look at spreads in the high yield space, preferreds are much more attractive, right? There's built-in cushion. There's, just as high, if not higher income levels. Default rates are much lower. And unlike high yield bonds or junk bonds, a portfolio like PFLD is invested in 50% investment grade securities. So again, that's an area that we're seeing a lot of people transition out of high yield funds into products like PFLD. And then finally, equity replacement. If you're looking specifically with the current discount that's out there, 10 to 15%, there's a tremendous amount of potential for capital appreciation. So if there's an equity investor that's really looking for risk averse, they may take down some equity risk or take some gains off the table, put it into a product like that and sleep much better at night. And then we always have the opportunity of tax loss harvesting as well, right? Most people do it at year end, but the good advisors and investors are doing it nonstop throughout the year. So if there's an opportunity to realize some losses and get into a product that potentially better fits to your asset allocation or your goals, it's always a great opportunity to do that.
Well, thank you, Lance, for taking the time to drop by. We appreciate your insights. We're going to have to leave it there.
Absolutely. Thanks for having me, Ron.
To learn more about the ETF lineup at Advisors Asset Management, be sure to visit aamlive.com. The link is posted in the description section below. Don't forget to subscribe to ETF Guide TV. Tell us how you've been enjoying our timely programs like this one. And you can also find us on X at our feed, which is at ETF Guide. I'm Ron DeLegge. Thanks for watching. We'll catch you on the next episode.